If you're making over $165,000 a year, you've probably been told you can't contribute to a Roth IRA. And that's technically true. But here's what most people, and honestly, a lot of financial advisors don't tell you. There's a completely legal workaround that lets high-income executives contribute to a Roth IRA every single year, regardless of how much you make. It's called the Backdoor Roth IRA. And in this video, I'm going to walk you through exactly how it works step by step, including the one mistake that could cost you thousands if you get it wrong. Let's get into it. First, let's make sure we're on the same page about why this is even a problem. A Roth IRA is one of the most powerful wealth building tools available to any investor. You contribute after-tax dollars, your money grows completely tax-free, and when you pull it out in retirement, you pay zero taxes. Zero. Problem is this: the IRS phases out your ability to contribute directly to a Roth IRA once your income hits a certain threshold. In 2026, if you're a single filer earning over $165,000 or married filing joint over $246,000, you can't make a direct Roth IRA contribution at all. For most of the executives and entrepreneurs I work with, that's just table stakes. They're well above these thresholds. So they assume the Roth is simply off the table. They move on and they miss out on years, sometimes decades of tax-free compounding. All right, let's take a walk through exactly how to do this. Step 1. Check for existing pre-tax IRA balances. Before you do anything, you need to check whether or not you have existing traditional IRA, SEP IRA, or simple IRA balances. Pull up your brokerage accounts and check. If you have a rollover IRA from an old job, you need to deal with that first, or the Pro-Rata Rule will come back to bite you. I'll explain how in the next section. Step number 2, open or use a traditional IRA. If you don't already have a traditional IRA, open one. You can do this at Fidelity, Schwab, Vanguard, any major custodian. It takes about 10 minutes to do online. Step number 3, make a non-deductible contribution. Contribute the maximum allowed amount. For 2026, it's $7,500 for those under 50, or $8,600 if you're over 50 with the catch-up contribution. Do not try to deduct this contribution on your taxes. It's a non-deductible contribution. You've already paid tax on this money. Step number 4, wait. There's some debate about how long to wait before converting. Some advisors convert the same day, others wait a few days or weeks to avoid anything that could look like a direct Roth contribution to the eyes of the IRS. My general guidance is to wait a few business days. Don't leave it sitting in for months, because if the balance grows at all before the conversion, you'll owe tax on the gains. Step number 5, now convert this to a Roth IRA. Log into your brokerage account and initiate a Roth conversion. You're moving the money from the traditional IRA to the Roth IRA. If you don't already have a Roth IRA account open, you'll need to open one at the same time. Make sure the money is in cash, not invested, before you convert. Converting invested funds creates an unnecessary tax complication. Step number 6, file a Form 8606. This is non-negotiable. This is how you tell the IRS that your traditional IRA contribution was non-deductible, and therefore that your Roth conversion is largely tax-free. If you skip this form, the IRS has no record that you already paid tax on that money. You could end up paying tax twice. Do not skip Form 8606. Make sure if you use a CPA or a tax preparer, you tell them that you did a backdoor Roth. Number 7, confirm the coding with your custodian. Call or message your custodian and confirm that the contribution is correctly coded as a traditional IRA contribution for the correct tax year, especially important if you're doing this in January or February for the prior year. All right, now let's talk about common mistakes. Mistake number 1, ignoring the Pro-Rata Rule. We touched on this already, but it's worth emphasizing. If you have a large rollover IRA sitting somewhere, you can't just do a clean backdoor conversion without tax consequences. The solution? Roll the pre-tax money IRA into your current employer's 401k, if the plan allows it. Many plans do. Once you've moved that balance out of your IRA, your only IRA balance is from a fresh non-deductible contribution, and now your conversion is clean. Mistake number 2, not filing Form 8606. I've said it once and I'll say it again. File the form. Every year you do a backdoor Roth IRA, no exceptions. Mistake number 3, waiting until December. You can contribute to an IRA for a given tax year up until the tax filing deadline, usually April 15th of the following year. But don't wait. Do it early in the year so your money has more time to grow inside the Roth. Mistake number 4, assuming your 401k blocks this. Your workplace 401k has no bearing on whether or not you can do a backdoor Roth IRA. They're completely separate. You can max out your 401k and do a backdoor Roth in the same year. Mistake number 5, leaving money invested before converting. If your contribution sits invested in the traditional IRA and gains value before you convert, you'll owe taxes on those gains at conversion. Keep it in cash, a money market fund is fine, and convert quickly. If you're not sure whether the pro-rata rule applies to your situation, drop a comment below with your question. I read everyone and I'll answer it directly. The backdoor Roth IRA isn't complicated once you know the steps, but the pro-rata rule is the piece that catches most people off guard. And if you have a rollover IRA sitting around, that's the first thing you need to address before you do anything else. And if you want to walk through your specific equity compensation and retirement picture with me one-on-one, there's a link below to book a free consultation. No pressure, no pitch, just a conversation. Because here's the good news. The clients I work with, I take care of these backdoor Roths for them every single year without them having to lift a finger. If this video helped you, hit subscribe. I put out content weekly specifically for executives and entrepreneurs. The stuff your HR department won't tell you. I'll see you in the next one.